Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of corporate filings so you don't have to. Today we're diving into the latest annual report from Meihua International Medical Technologies. It's a long one, so buckle up. We uncover the key details, including a fraud case, changing financials, and the risks that could affect this medical device company. Meihua International Medical Technologies is a Cayman Islands holding company that operates through its subsidiaries in China. They make and sell disposable medical devices. But this report isn't just about business as usual. It seems there's some drama involving a potential fraud. Right off the bat, the report talks about a shady situation connected to their initial public offering, or IPO, where they believed they were defrauded of over $10 million. Apparently, after their IPO in February of 2022, they discovered that they had entered into agreements with a Hong Kong entity called Taihei International Group, and now suspect they were conned. The company says that Taihei agreed to invest a minimum of $35 million in the IPO, but only if Meihua made a $7 million service fee for investor relations and other services. Meihua made those payments, but Taihei never actually invested. The company now believes the Taihei agreements may be a fraud and are working with the SEC to resolve such matters. As a result of all this, the company had to write off about $4.8 million for the deposit and fully expense 2001 Act 2 to include shareholder lawsuits and SEC enforcement actions. Now that's definitely not good. Let's move on to the financials. The annual report shows revenue slightly decreased by about $0.19 million. Landing at $96.91 million for the year ended December 31, 2024. The financial report attributes the slight revenue decrease with the disposal of their equity interest in Hainan Goxi, or they no longer consolidate that portion of the revenue towards with the disposal of their equity interest in Hainan Goxi, or they no longer consolidate that portion of the revenue. The company's net income also took a small hit, decreasing by roughly $0.75 million, or about 7%. This brings the net income down to $10.84 million TAV for the year ended December 31, $2,084 million. For the year ended December 31, 2024, the company attributes this small decrease to increases in operating expenses, which is generally not a good sign for the financials. Meihua International Medical Technologies is categorized as a non-accelerated filer and an emerging growth company. The document says that this classification exempts them from certain financial reporting requirements, which in turn reduces the information available to outside investors to evaluate their performance. Now let's dive deeper into some other interesting things I found in this report. The company admits that while they utilize a bunch of suppliers, they do not have long-term contracts with any of them, meaning at any time a key supplier could reduce or terminate services. This company seems to rely on its customer base, and the company reported that about 41% of the sales in 2024 came from their top 5 customers. If you lose any of those, it will be a big hit to their bottom line. I'd like to see these numbers more spread out and a diverse base of customers instead of relying so heavily on a small number. They operate in an intensely competitive industry, so the company may have to compete and even lose existing customers to competitors. They also acknowledge facing increasing competitive pressures to grow the business and that some potential competitors may have significantly greater resources than they do. Another major risk mentioned in the filing is that changes in trade policies, especially between the US and China, may negatively affect their business. Since they sell internationally, tariffs or other trade restrictions could hit demand for their products. One more major thing that caught my eye, their stock might get delisted. The report mentions the Holding Foreign Companies Accountable Act, which says that if US regulators can't inspect their auditor for a few consecutive years, the stock could be delisted. It's all tied to tensions between the US and China and regulatory oversight. In addition, the company is not presently in compliance with the continued listing requirements for the Nasdaq stock market because the bid price is too low. If they don't regain compliance, the company's ordinary shares may be delisted. Lastly, it's worth noting that the company's directors and officers have a significant amount of control over the company's shares. This means that they can sway the outcome of big decisions, even if it's not necessarily in the best interests of all shareholders. Meihua International Medical Technologies certainly has some hurdles to clear. The past accounting issues, especially with the failure to initially disclose those agreements and the current compliance issues with Nasdaq listing requirements and The Holding Foreign Companies Accountable Act raised serious concerns about their financial controls and their compliance practices. So far, it seems the risk wasn't fully managed and it led to significant impacts for the business. But all hope is not lost. Despite the accounting and SEC drama, the core business of manufacturing and selling medical devices seems to be holding steady for now. The company could be promising in the long term because they have a good distribution network of clients, distributors and suppliers. Thanks for tuning in. If you found this helpful, don't forget to like, comment and subscribe to Corporate Decoder for more deep dives into the world of business and finance.